Let's talk about valuation and modeling in a hedge fund. We did a very lengthy case study on LinkedIn and modeling. I'm going to discuss only a little bit of what we covered there, but I'm going to kind of focus on how hedge funds look at modeling and valuation differently from other sectors. Okay, cool. So hedge funds, of course, are usually shorter term focused, unless they're tiger cubs. Right? So short-term focus means 1 to 2 years. Okay. So they care about earnings 1 to 2 years out more often than not. And they're a little bit more focused on quarters and guidance. And it's very difficult because sometimes you can actually be fooled by randomness. You can be wrong for the wrong reasons or vice versa. Okay. They focus a little bit more on a catalyst than other investors do. Right? There's got to be a reason for them to invest right away. A nightmare scenario for a hedge fund is if they invest in a company and the stock is just dead weight. It trades sideways for a long time. So they're more focused on a catalyst, and they're actually more focused on sentiment as well. The smart money tends to buy when others hate stocks and vice versa, or they can play momentum as well. Before I get into the model side, what I'm going to do is, or the valuation side, let's go to our model quickly here, right? We looked at revenue and we built out the income statement, balance sheet, etc. Hedge funds don't care about building out the balance sheet at the bottom here, or the cash flow statement for that matter. And they don't really care about DCF usually either, right? They care about the income statement and a couple of items usually on the balance sheet, right? So on the income statement, they tend to, actually I'm going to close it up here because they tend to focus just on this year and next year, right? And they focus more on quarterly numbers, right? And so these are the numbers they be focused on. Recall that green means this information is coming from a different tab, okay? And blue means they're hard coding for this year. Everything else is a percent based on that. And remember, modeling is really easy. It's just basically a percent of sales, right? And so we can see from previous years that the percentage of sales was higher for each line item, and we're just focusing on them decreasing over time. And remember seasonality as well. Okay, cool. So what happens, you focus on this year and next year and you're modeling your numbers and you get these earnings estimates. And so hedge funds care more about the income statement and the balance sheet than anything else. On the balance sheet, they might look at, the cash balance and the debt balance and what's called deferred revenue, which means what happens if revenue slips into next quarter, meaning a pipeline. And again, we're just looking at this year and next year. And again, you want to comment your cells as much as you can. Okay, cool. Let's go back to our presentation now. Cool. So we don't care about the DCF, okay? And that's at the end of our tab, or our model right here. Here's our valuation metrics. We don't care about this stuff here, right? We don't care because hedge funds only care about shorter term stuff, not long-term stuff. And the DCF is really not the best way to value companies anyway, in my humble opinion, because there are so many independent variables, anything can go wrong. Less is more. So we're going to look at price to revenue and price to earnings for our price target. And so let's get rid of the stuff we don't need here and just focus on the two aforementioned categories, price to revenue and price to earnings. Okay, cool. So let's look at price to revenue first, the left-hand side, okay? And so hedge funds tend to focus on different scenarios. There's bullish, bearish, right? Or just right. So think of Goldilocks and the three bears. My favorite is the mama bear, which is just right. Okay, cool. So the bullish price target scenario for price to revenue, yeah, basically told us that our target price this year will be $286. Okay, and that's 10 times revenue, right? And it's debatable depending on what sector you're looking at, right? And value investors will hate to listen to this, but that's okay. I want to kind of create a menu for everybody here in this course. Okay, and if you want, you can look at the out year as well. If you value your numbers on the out year, it's up to you. Again, I'm providing a menu. You do whatever you want. I'm providing you with all the tools to do so. Okay, cool. So here's the bearish price target for this year and next year, right? It's obviously much lower than the bullish price target, right? And then we've got the just right scenario, which is always my favorite. Okay, cool. So let's assume that our price target here for price to revenue is $215, which is 7.5 times our revenue estimate for this year divided by the number of shares. 215. Okay, great. Now, let's move on and discuss price to earnings this side over here, okay? And what we'll do is we'll also look at different scenarios. Let me back up for a second here. Bullish, bearish, and just right, which is my favorite. So the bearish price target using price to earnings would assume the peg is 1, and that means the price earnings divided by the growth rate is 1 times. And so if a company is growing earnings at 30 or 29 times, then it should trade at 29 times earnings. And this year, if it's growing earnings at 22%, it should trade at 22 times that number. Okay. And that's what this number is here is 22 times $4.50, about $100. Okay, cool. Now, let's take a look at another scenario, which again is my favorite, which is the just right. And the just right, we can look at this year or next year. Let's just do this year. Keep it simple. We got 1.5 times price to earnings growth rate, which means we take the earnings growth rate times 1.5 times the EPS, and it gets that price target. Okay, cool. So we've got both the PE here, right here, and the price to revenue here, right here. And this is our price target on the P to R side, price to revenue. And this is our price target on the price to earnings side. I'll always love to use at least 2 different valuation methodologies so you can minimize your margin of error. Okay, cool. Let's put this puzzle together then. There we go. Great. So our price target here for price to revenue is $215. Our price target here for price to earnings is $161 divided by 2, and that is our target price.